If you keep up with financial news, an unhealthy practice by the way, you've probably heard tell of the dreaded flattening, or worse, inverting of the yield curve. An inversion happened toward the end of 2019, just before the COVID crash in March 2020. It happened in 2006, before the Great Recession. In fact, it's happened before the last 8 recessions. And parts of the yield curve are inverting today. What exactly all that means, and what we can learn from history to best help you prepare for the future, coming up. Welcome back, you savvy 17,000 subscribers. I appreciate you. And I laud your curiosity as we try to figure this all out and find the best ways to invest. And even if you don't invest directly into bonds, their insights can be extremely valuable for stock and real estate investors alike. But before you can understand what the bond market yield curve is telling you, you have to have at least a basic understanding of how bonds work. Here's a simple example, and having this context fresh in your mind will help later when we're looking at the yield curve. Pretend you loan me $1,000 on the condition that I pay you $50 every year for 5 years and then pay you back that full $1,000 at the end of that 5-year term. If I were a business or the government in that example, that loan is a bond. In this example, it's a bond with a 5% interest rate. $50 is 5% of the $1,000 principal. But now, after you've purchased this bond from me, if you decide you want to sell our contract so that somebody else owns the right to my regular payments of interest and the ultimate $1,000 I'll pay back at the end of our term, I don't care. By all means, sell the bond in the secondary market for whatever you want. It's all the same to me, the corporation, the government. My obligations are the same. Now, if you go to sell it in a year, and now all the issuers of bonds are selling them with a higher interest rate, say 10% instead of the 5% I'm paying, is anybody going to want your bond? Well, sure, but they won't want it at the price or value you paid for it. They'll want it to be discounted so that their yield is ultimately closer to what they can get somewhere else. If they can get 10% in the open market and we all have the same credit worthiness or ability to pay, well, investors are going to want that same yield from any bond contract they might buy from you. So if you discount all those future payments, the $50 per year and the $1,000 lump sum at the end of the term, now 4 years away, if you discount all those payments by the prevailing rate, now 10%, a bond investor would be willing to pay about $842 for it, for our contract. Which means over that single year, you've lost around 11% on that investment, even despite the $50 I paid you for that first year. Now you know how those bond investors we were talking about a couple of days ago feel so far this year. But the inverse is also true, of course. If interest rates start to drop and you've locked in this higher rate, your investment is naturally going to be worth more. Say when you go to sell your bond in a year, the prevailing rate is only 2% instead of 5 or 10%. Well, now when you discount your bond's future cash flow back to today at a yield of 2%, your bond is worth $1,114. which would represent a return on investment of more than 16%. That's great for a bond investor. Now you can understand why bond investors have done so well over the last several decades as interest rates have fallen from almost 20% in 1980 to almost 0% today. With that example, hopefully you have a better idea of the difference between the bond's interest rate and its yield, and the consideration the bond investors are making as they purchase bonds with various maturities. That is, the length of time between now and when they would ultimately get their principal back. Effectively, it's how long they're locking themselves into that rate. So normally you would expect a later maturity to be able to demand a higher yield. You're locking yourself into that rate for a longer period of time, whether the prevailing rates fall or go sky high. So here's what a normal curve should look like. The shorter maturity treasury bonds have yields very close to whatever the Fed funds rate is at the time. But of course, The further out you get, under normal conditions, investors require higher and higher yields, with it usually leveling off at the higher maturities. Now, put your bond investor thinking caps back on for a bit. Here, let me grab mine. If you're the portfolio manager of this big old pension fund or life insurance company, you're trying to be savvy and safe with the money you're in charge of investing. Now, let's say all your high-tech, expensive analysis tools and maybe even staff research analysts and consultants are telling you that the economy is crazy healthy. Things are taking off. Growth is inevitable, and inflation probably is too. But since the economy is healthy, the Fed will be able to raise rates significantly over the coming decades to keep up with inflation. Anyway, there's your summary analysis. So, as this big shot investment decision maker for this massive conservative portfolio, do you lock yourself into a 30-year bond yielding a measly, let's say, 2%? Inflation, healthy economy, rising rates? No. If that's what were to be offered, you'll just stick to the shorter term maturities. So as they mature, you'll be able to invest at higher and higher rates, right? That would be the astute thing to do. But wait, if all of the behemoth portfolio managers, that's a reference to the size of their portfolio, not person, yeah. If they're all seeing the same thing or consulting with the same consultants, well, they don't want the 30-year bonds for a measly 2% either. And well, if there are no buyers and the Treasury Department is trying to sell them, well, basic supply and demand, they gotta offer more. They gotta up the interest rate. So that kind of optimistic outlook can lead to a steeper than normal yield curve. It shoots up quicker than normal and doesn't necessarily ever level out. Here's what it looked like toward the end of the Great Recession, for example, as the economy was clearly starting to roar up again. So as a mere observer of the yield curve, and not actually a big shot portfolio manager, I mean, if you are, cool, but most of us at least are not, we're just reading the tea leaves that are the yield curve inputs. So as an observer of the yield curve, when you see this steeper pattern, you know what some of the largest players in the investing world, remember the bond market is way bigger than the stock market, what the largest players in the investing world are expecting, what they're seeing with their vast and cutting edge resources. Pretty cool, right? A flattening yield curve can imply uncertainty or uneasiness about the future. Companies are willing to lock in long-term rates even if they're similar to the shorter-term maturities. As you can understand now, that's not a great sign for our economic future. And when the yield curve inverts, meaning these massive and savvy institutions are even willing to lock in longer-term rates that are lower than what they could get with shorter-term maturities, what do you think that means about their educated expectations for the future? It's not good. Yield curve inversion does not happen very often and is strongly suggestive of a severe economic downturn. David Kelly from JP Morgan quoted for the Financial Times, "An inverted yield curve doesn't do much to the economy, but it's a very bad sign. The only reason you'd buy a long-term bond at a lower yield than a short-term one was if you thought yields were going to fall. That usually happens when most people think the Fed has gone or will go too far." And on March 28, the spread between the 5-year notes and the 30-year bonds inverted for the first time since 2006. The bond market thinks the Fed has gone too far after a single hike? Yikes. More on what all that could mean in a second. Here's where we are today. Historically, the most indicative inversion has been the spread between the 10s and the 2s, the 10-year and 2-year maturities. And you can see here from the Treasury database that the distance between the two is getting awfully tight. In fact, Seeking Alpha reported the yield on the 2-year Treasury briefly exceeded the 10-year on Tuesday for the first time since 2019, in a warning sign that coming Fed rate hikes may trigger a recession. The inversion only lasted several minutes before things returned to a 5 basis point spread. It was this 10-2 spread that inverted only briefly in 2019, which was followed by the COVID crash in March 2020. It happened for much of 2006 and into 2007. It was even more inverted in 1998 and 99. In fact, as I pointed out at the top of the video, such an inversion has occurred before all of the last 8 recessions. Now, it's very tempting to argue that this time it's different. That's a common refrain in the financial industry, isn't it? Well, it absolutely is different, but it's also always different. That's a big problem I have, side note, with the stock and bond only philosophy. Yes, the inputs, the variables are always different, so nothing is perfectly predictive. It seems that the industry likes to use this logic selectively. The bottom line to that logic is you always have to proceed with caution with any of this stuff. So sure, be cautious, be skeptical if you want, but don't be stupid. Don't entirely write it off. Aaron Brown, a fund manager at PIMCO, said, "There's reason to believe that this time around yield curve inversion may not be as good of an indicator as it has been in the past, particularly given the enormous amount of quantitative easing undertaken by global central banks." Sure, be skeptical, be cautious. I agree, the Fed is a big differentiating variable this time around. Other things were different all the other times around. In fact, look at all this data, as compiled by the firm Real Investment Advice, that economists could point to suggest a healthy economy. So maybe it is wrong this time. Oh, wait, no, sorry, that data was from 1999, a bit after the 10-2 yield curve inverted. Right, sorry, my mistake. The run-up to 2008 was similar. Most economic variables looked strong. There seemed to be no clear indications of a coming recession, other than the yield curve inverting. And here's all that data from today. Yeah, for the most part, it looks good. I give you the information. You draw your own conclusions here. I do think the Fed's hyperactive involvement is different, but I think because of past policy decisions they made, they've really dug their own grave here. They're stuck between a rock and a hard place. There's no easy way out. You see, they have contradictory objectives here. They need to keep inflation under control. But they also know that they're going to get blamed if the economy starts to go into a recession. So you bet they're trying real hard to not trigger that, of course. Here's Congress recently trying to point this out as they interviewed the Fed chair.
Is the leadership at the Fed under you and the Fed prepared to do what it takes to get inflation under control and protect price stability?
Well, let me say I knew Paul Volcker. I'm pretty sure I saw him testify in this room many years ago. I think he was one of the great public servants of the era, the greatest economic public servant of the era. And I hope history will record that the answer to your question is yes.
So you're prepared to do what it takes without any reservation to protect price stability?
Yes.
That would be a departure of what you've done. Thank you.
The political talking point right now is that the economy is booming, but the Fed's actions belie their posturing on this issue. They acknowledge the Paul Volcker, whatever it takes to beat inflation attitude, but their policy decisions are far, far from that. I talk in more detail about that in this video that I'll put in the card and link out to in the description. But yeah, for quick context, he attacked inflation by allowing the Fed funds rate to soar to almost 20%. Yet now, as we experience runaway inflation similar to, if not greater than, what we experienced back in the 1970s, and for months we just talk about, and then sure, finally execute on, raising interest rates by 25 basis points or 0.25%, all while we continued to buy more treasuries, pumping even more money into circulation. Yeah, he's really channeling his inner Volcker there, yeah? What's more telling about at least what the market expects the Fed to do is the yield curve. Remember what it looks like if the economy is healthy and investors fear inflation? A steeper than normal curve. It makes sense. Everyone is worried about inflation going up. Over the long run, the Fed will obviously have to raise rates to get ahead of it. The economy is actually healthy enough to handle that said raising of rates. So one would expect the Fed to follow through without backlash, which would mean when they do raise the rates, conservative investors would have access to even higher interest rates to invest their money. So in that scenario, if you want me to lock up my money into some interest rate today, it better be worth my while, right? You're going to have to pay me much more than I could get in the short-term market to buy your long-term stuff when I think there are going to be higher yielding opportunities later. But if that's not what we're seeing, which we're not, remember that the 30s are below the 3s and we're, for a moment, below the 5s, then what does that mean? It means the market doesn't actually believe the economy is that healthy and that it expects the Fed to bend to the political pressure that will come from the inevitable recessionary scares we're about to experience. In my humble opinion, if the Fed continues raising rates, there will be a recession. Now, I actually think a real resetting recession is long overdue, and it's just been made worse by all the can kicking over the last couple of decades. Maybe that's an unpopular opinion. It certainly would not go over well politically, as it would be painful, even if necessary. But, again, in my opinion here, the real question is just when the Fed will change its policy again. When they will back off these aggressive, teeny tiny rate hikes because the recessionary political pressure has grown too great. They'll have to make up some excuse to try to save face so they can back off their aggressive anti-inflationary policy. Now, don't get me wrong, I don't think they'll prevent a recession by doing this. At some point it will become inevitable, but they might be able to kick that can just a little bit further down the road. Maybe even long enough to be able to blame another administration. Anyway, I think that's what's going on here. At least that's my interpretation of the tea leaves that is the yield curve. Now, a couple of important things to note. Even after the 10-2 spread inverted before the last 8 recessions, the market tended to surge upward before its ultimate and significant downturn. In fact, on average, it took 17 months before a recession finally came to bear. Also, over that same time period since the 1970s, some argue this indicator has given off 1 or 2 false alarms. But that's it. In the end, I think it's important to note, as Ben Emmons, a global macro strategist with Medley Global Advisors, pointed out, historically a recession has not happened without an inversion. So likely it will be a predictor of a future recession. Timing, however, is unknown. It could take up to 2 years. Amid all these concerns, my goal is just to be able to help you invest smarter. For you. Finding the best strategy that will work for you is a very individual thing. And if you want to know some of the best places to invest during inflation, I put together this video just for you. And if you're trying to improve your individual stock selecting skills, you should check out this playlist. All of those will help you be better prepared for what's ahead. Let me know in the comments how I can help. I love getting to know you all better, and I wish you all the best. Take care.